Good morning. What a beautiful day it is. Appreciate you being here with us today. Today we're going to talk with our partnership with the SBA about positives and pitfalls of online funding for small business. You know, debt's not a bad thing if you can manage it. And also there's many avenues today that you can borrow money that I would consider predatory lending, to where the next thing you know, your interest rate it goes up, and it can really affect your business. So that's one of the things we're interested in, is increasing the financial literacy of the businesses that we work with to make sure that the decisions they make does not have negative impacts in the future for them. So I appreciate the SBA, great partner in the things that we do. And if anybody has any questions, I'm sure Kim and her team will be glad to answer. And the same here with us at the Bluefield West Virginia Economic Development Authority. Our website's mybluefield.org. If you need something, please let us know. Kim, I'll turn it over to you.
Thank you, sir. Appreciate that. And if we're going to talk about online funding options, we need to discuss fintechs first. Now, the broadest definition is any app or software or technology that really allows people or businesses to digitally access and manage their finances or make financial transactions. So the tools can include those online banking and payments with your more traditional financial institution, or perhaps a loan from a lender that has no physical location. You can also plan your retirement and manage that, and of course, lending, both personal and business. And consumers really like fintechs. During 2021, use of fintechs products jumped from 58% to 88%. It's easy to understand why people like using these tools. For the most part, they're straightforward. They allow for faster transaction. Other advantages are that fintechs have opened a wider range of financial services for many people, including those who were previously underbanked or unbanked, meaning that fintechs are more inclusive. They're democratizing financial services. For example, using the apps and online financial services has already surpassed traditional banking among Hispanic people in the United States. Fintechs can have lower fees. We'll talk about that in a minute. And 7 in 10 consumers say that fintech services have made finance a part of their daily lives, and they're more confident about their finances. Now, on the other side, there are some predatory practices by some fintech services. The range of financial products can be confusing, and the regulation, at least in the past, has typically lagged behind. Now, it's not a secret that many entrepreneurs, Jim can tell you this, can't get affordable loans. We're talking primarily about rural small businesses, minority and women-owned businesses. They're less likely to receive credit, and very small businesses that need small dollar loans. Now, SBA has introduced some new plans to address those gaps. And I think that means we're going to be seeing more online lending, not less. And again, though, this can be a good thing because it gives more people access to business funding. So, as Jim said, our goal today is to help you understand the nuances of this world. So today we're going to talk about digital lending in general, then move on to peer-to-peer. Then we're going to take a hard look at some specific financial products that are a bit unique. We'll also get into rewards-based crowdfunding as a business funding option. And lastly, take a quick look at equity crowdfunding. Online businesses are a legitimate way to get financing through business, but they're generally best for business owners who can't qualify for a bank loan or need the capital fast. According to one report, the global digital lending platform market size was valued at $7 billion in 2022 and is actually expected to register an annual growth rate of about 26% per year from now until 2030. Now, just to give you an example of how much online lending has grown, here are the top 5 SBA lenders for 2022. These are traditional bank loans guaranteed by SBA, but you'll notice that 3 of the top 5 are online only institutions. Now, some of the online business or personal loan sites you're going to find are technically loan brokering sites, and you won't immediately know that you're working with a brokering site or a brokering company. These sites will take your information, sometimes do a soft credit pull, and then they're going to share your information with its network of lending partners. Probably the most famous is Lendio. Now, there is going to be a commission as a percentage of the loan amount paid by the lender, normally 1 to 2%, and this commission is passed on to the borrower. Just a note, while it's not as large or easy to use, SBA also has a service called Lender Match, which is commission free, and it's actually going to get some serious updates in the next few months. Pros. You'll likely get multiple offers for funding, which gives you some negotiation room. The process is normally very quick. You'll see things like apply for a business loan in 15 minutes. Another pro is that while there are countless financing options available, using a service like this can make it easier to find the right product for you. However, in addition to the interest you're going to pay for taking out the loan, there are, again, those commissions, and there can be additional fees and charges that you'll need to watch out for. Sometimes when you're using these services, you don't know it's a service and you'll have that loan come through, again, from a lender you may have never heard of. This happened during the PPP lending phase. And finally, once you get the loan, it can actually be difficult to find a live person to talk to if you ever have any issues. Peer-to-peer lending is technically considered a form of crowdfunding. Now, but today we're going to talk about it separately. Now, one report estimates in 2021 there was $274 billion raised, and that was actually an increase during 2022 to 407 billion, and it's estimated to be 1.3 trillion by 2031. Now, this is worldwide, but the trend has been for the US to take up most of this space. Now, the key difference from traditional lending is that the lender is a peer, or rather a group of individuals, and it's not a bank or other financial institution. You will have a borrower and a group of small investors, and the platform actually just serves as the conduit between the two. Now, in the past, these have been personal loans, but more and more are offering business loans. However, today you'll find that your peers are not only small investors like you and me, but also institutional investors and high net worth individuals. And that does change the game a bit. Now, you may be wondering why so many individual investors are putting their money into a platform that lends money. Well, the returns have actually been better than the stock market for those investors. While there are a few differences in platforms, there are several common characteristics. Your rate is going to depend on your credit score. The higher your score, the less the funding costs you. And those interest rates are going to range anywhere from 5.24% up to 38%. Now, they normally offer fixed rates. The length of the loan varies, but most of the platforms are going to offer anywhere from 6 months to 60 months. All of them are going to charge an origination fee. And for business loans, the platforms are going to require financial accounts and a track record. Peer-to-peer lending is quick and mostly easy, so that's a big positive. And even if you have a bad credit score, you're still eligible. Now, many are still going to look for at least a 600, but some of the platforms don't. For example, Fundbox has no minimum credit score requirements, but they will, for a business loan, require at least 2 to 3 months of transactions plus a base revenue of $50,000 or more, again, for its business loans. And there are many of these platforms giving you a lot of choices. However, peer-to-peer lenders prefer to work with smaller amounts as compared to more traditional lenders. They are likely to be there are likely to be more and higher fees, and those very high interest rates are possible if your credit is poor. Now, I'd like to move on to some of those newer products that emerged originally during 2008. If you're already in business, you know that you have the option of selling your accounts receivables to raise money for your working capital needs. You're basically using it as collateral. That's called pledging, and that's been around for a while. Factoring, however, is selling your accounts receivable to a third party. That third party, also called a factor, typically pays about 80% of the face value of the receivable up front. In other words, if you sell a $100 invoice to a factor, you'll be paid $80 immediately. The factor is then going to collect payment from your client when the invoice is due. It's going to deduct its fees, usually 2 to 6% of the total invoice, and it's going to forward the rest of the cash to you. So if you agreed to pay a factor 5%, the total amount you would collect on your $100 invoice would be $95. And if your credit isn't great, it likely doesn't matter because factors are more interested in the creditworthiness of your customers. Now, I see a lot of trucking companies using factoring, but we're told that factoring works best for businesses with a lot of cash tied up in accounts receivable, like wholesalers, distributors, and drop shipping companies. Additionally, there are typically no long-term contracts involved. And if you decide to pursue this option, we're told to make sure you've got a decent profit margin built in, a margin of at least 25%. On the positive side, you've got immediate cash flow. Plus, there's a higher chance of approval depending on the quality of your customer, and your collateral isn't tied up. The cons are that it's expensive, you do lose control, and if your customers don't pay, you're actually on the hook for those invoices. Business cash advances were originally called merchant cash advances, and they're made to your business based on the volume of your business's monthly credit card transactions. Now, businesses can typically receive an advance of up to 125% of their monthly transaction volume, and that's going to be averaged over the previous 120 days. Now, terms are going to vary pretty widely from lender to lender. Some lenders are going to take a fixed amount of money out of your business's account every day until the advance is repaid with interest. And other lenders are going to take a percentage of the credit card sales paid to you each day, just a percentage off the top. Now, if they take a percentage, it's usually 5 to 10% of every debit and credit card transaction a business processes until the advance is paid back with interest. The best candidates, though, for merchant cash advances are business with really strong credit card sales, primarily retail stores and restaurants. However, we've actually seen this offered and accepted by businesses who don't have those strong credit card transactions. They're taking advantage of the business cash advance, and they're having funds deducted out of their account automatically, and that can be very expensive. And the businesses I've dealt with, this has been problematic for them. So the pros and cons: businesses do receive quick access to cash. It's also relatively easy to do. Business cash advances also, those lenders aren't as concerned with your credit score as traditional lenders are. But the biggest downside to this tool is that it's expensive. While the average interest rate is 5 to 10% per month, there are some lenders out there that are offering interest rates of 30% a month and higher. It's also a short-term solution. And it's risky because it's based on future sales. And that's something that you may not be able to guarantee. Now, one other product I do want to introduce is the sale leaseback or the sale back lease. Now, this is where a company sells an asset and then turns around and automatically leases back that same asset from the purchaser. So the seller of the asset becomes the lessee and the purchaser becomes the lessor. Sale-back leases are used when a company needs to raise capital, allowing the company to have both the cash and the asset it needs to operate a business. So the companies pull equity out of their real estate, et cetera, and use that capital to reinvest in the business, or to finance strategic initiatives like, mergers, acquisitions, expansion, or even new equipment. The most common users of the sell-back lease are builders or companies with high cost fixed assets, like property, land, or large expensive equipment. And as such, these leasebacks are more common in the building and transportation industries, as well as real estate and aerospace. I honestly haven't seen a small business be able to take advantage of this, but if you do see this in the financial marketplace, we wanted to make you aware of that. Rewards-based crowdfunding is fun. There are lots of great stories about successful campaigns, but on the other hand, PR has really been too good because it can lead people to have unjustified expectations. So you know the process. You set up a campaign to solicit funding. There's folks out there with money. They go to the platform that you've chosen. They choose your campaign, and then they're going to supply money to you. You then send that group of backers a gift or a reward. Now, if your campaign involves the development of a new product, like a new type of watch or tennis shoe, etc., one of the high rewards is usually one of those items. Businesses asking for just plain donations with nothing to provide in return don't really do as well as businesses looking to fund a specific project. And if you have potential backers who are interested in philanthropy, you're really going to be competing for their attention and dollars with individuals who need money personally. Some of the things I've seen are medical bills and school tuition. Now, back in 2012, when we first started talking about rewards crowdfunding, it was worth about $2.7 billion. It's actually estimated that it's going to go to $300 billion by 2025. When it works and works well, crowdfunding can get you flexible financing for your project without you giving up any equity. But it can also help you build buzz about a new product or service that you're introducing, and help you build a following for your projects and your customers and your company. This is a list of potential customers. There are two funding models. That is how you get paid. There's the all or nothing or the more flexible model. An example of all or nothing is that you have a fundraising goal, say of $5,000, and you only raise $4,000 by the end of your campaign. In an all or nothing scheme, you're not going to receive any of those funds. We hear a lot about Kickstarter. Kickstarter is an all or nothing platform. Now, under the flexible or keep it all model, if you raise $4,000 on a $5,000 goal, you're still going to be allowed to keep that $4,000. Indiegogo offers you a choice between the flexible and the more stringent model, but you've got to decide that up front. But you're also going to pay more for the flexible funding. And traditionally, all or nothing campaigns are actually funded at twice the rate as campaigns that use the more flexible funding model. Now, before you start your campaign, you're going to need some important aspects already set up. Your branding really needs to be in place, and it needs to be professional looking. And you need to know who your customer base is and have that marketing information ready to go. You need to have a manufacturer lined up for either your product or your reward if you're going that route. And you need to have worked out who's going to be getting the reward or product from the manufacturer to the backer. And if you're shipping or it's something you're going to deliver electronically. And finally, you need to have the financial savvy to make this a profitable project. So assuming all of that is in place, that you've got that strong foundation, there are 6 factors that most experts believe are indicative of success in rewards crowdfunding. Number 1, amount requested. For example, on Kickstarter for several years, the majority of successful campaigns were over $1,000, but below $10,000. And the most successful projects are those for things like games, design, and new tech. You do need to have a great video that is compelling and where you and your project, well, you come off as authentic. Now, according to Kickstarter, the best campaigns last only 30 days. That's sort of a short enough duration to maintain urgency for the backers. You're also going to need to have a reward that makes sense and has value. You know, contributions for nothing or something cheap, you know, like a t-shirt or a, you know, keychain, that's not the way to go. The best rewards offer some kind of value to the backer at a reasonable price. Now, this value, as we said earlier, could be the actual product. And in that instance, you're actually using the platform as a sales stream, or input into the project. People like that, or really some sort of exclusivity for early adopters. For example, one of the best examples I saw was a campaign to support the publishing of a book. And it offered rewards like naming a character after a backer, allowing the backer access to exclusive content like, you know, drafts and perhaps a first copy of the audio edition, or even a one-on-one sit down virtually with the author. You also need to have developed or are developing a strong network. If you're going to do multiple campaigns for multiple projects, a lot of your success is going to depend upon the network or potential backers you may already have. You know, successful crowdfunders talk about how important their network or community is, but especially backers from previous projects, because you can convert them into new backers. The typical conversion rate is 3%. That is, only 3% of your existing network is going to participate in any given project or campaign. That means the bigger your network, the more successful you can be. Overall, you need to be communicating regularly with that network to get people excited before your campaign launches. And when you have interested people investing from the start, your product or service is perceived as more value. Now, this approach also presumes that you're, as I said, going to have multiple campaigns. So if you're building a business, you might want to consider breaking large projects down into smaller, more easily explained campaigns. You also need to be aware of how you structure the rewards, as that actually can impact your success. There's an interesting study from Georgia Tech from just in 2020 that looked at the number of options for rewards, how much those reward levels varied, and the impact of the reputation on the campaign's creator. That report found that if you offer too many rewards, your potential backers are overwhelmed. The report also suggests keeping the cost of the different levels reasonably close. And the report says that businesses with more crowdfunding experience can also offer fewer rewards because they're reviewed as more legitimate and trustworthy. And get this, even if the prior campaigns were not successful. So let's look at the pros and cons. Number one, no collateral, credit check, or previous business experience required. That's great. The process itself is pretty simple, and it doesn't require you to have professional financial or legal help. And exposure can actually help you establish a customer base for your products or services. However, it isn't the best option if you're looking for large amounts of funding, unless you have something that's super, super compelling. If you don't reach your goal, you may not be able to recover or receive any of the amount raised, depending on the funding model you chose. And one last thing, and this is just me, but online exposure also means exposure to potential competitors. I always think that, you know, it's not always the first person to market that's going to have that long-term success. Now, I did want to give you just a few examples. All of these campaigns are over, so I think we're safe in there. But this first campaign was publishing a book about regenerative agriculture. I had no idea what that was. I do now. This company actually had 15 million views on its blog, over 160,000 subscribers on YouTube. But I want you to note the funding levels and the electronic versions of the book that backers can choose between. You know, you can get a physical copy if you pay more, an electronic one at a lower reward level. And at the highest level, you can receive all 3 of the books that he's written, but all of those are going to be electronically available, not in hard copy. Now, this is another example. It's a campaign for an animated film, and I wanted to use this because I wanted to point out that the pledge levels here are also fairly close together, but they're also inexpensive. He's not providing any physical reward, so his costs are going to be minimal. It's really about advertising you as an early adopter, and his film was actually or his video was actually very good. He came off as very authentic. And, I was tempted to look at this as well. Now, this is an example of a great product that raised lots of money, the Coolest Cooler. However, this is my cautionary tale. Even though the branding and the marketing was in place, the campaign went downhill fast when their manufacturing and fulfillment systems broke down. The original plans were to deliver the actual physical item in February of 2015. This is a little older. And as the campaign became more successful, there was more demand. So due to the change in quantity and increasing complexity of shipping, they ship from China, and other logistic problems, the production took longer and the company moved the ship date from February to July. Okay. The first units were actually shipped in July 2015. And by November, it was a process. Tens of thousands had actually gotten their cooler. But there was still this significant backlog. And they estimated at that time that wouldn't be cleared up until April of the following year. However, in the meantime, production stopped again. And the business went looking for an additional $15 million. But if that additional money that they were looking for, 1/3 of this was going to be put towards meeting those 36,000 outstanding orders. And from there, it just all spiraled downward. And in December 2019, the company announced that it was ceasing operations, and the state in which it was established hit them up for fraud. Lastly, equity crowdfunding. Just like traditional equity financing, you are giving up a percentage of your business. Now, in 2012, only accredited investors, those with, say, $1 million in net worth or who earned at least $200,000 per year, they were the only people allowed to invest in startups. Currently, individuals can invest in startups regardless of their income or net worth, though there are limits on how much can be invested. It took a number of years to finally get those regulations out. So here are some things to know. The crowdfunding investments, or equity crowdfunding, can only be made through an online platform operated by an intermediary, which is a registered broker dealer or funding portal. They have to be registered. A company is permitted to raise a maximum of a little over $1 million in any 12-month period. And as I said, individual investors are still limited in the amounts they're allowed to invest. So as an alternative, you may want to look at intrastate equity crowdfunding, because to a greater extent, it has been more exempt from SEC rules. So you may want to see if there's a state-based platform available that could conceivably come with fewer strings attached. However, there are still going to be requirements to keep these platforms and businesses outside of that federal purview. The principal place of business should be in state, and the sales are only to in-state residents, et cetera. The rules get really specific. And keep in mind that your state could actually have more stringent guidelines. So here's what we need to know. The main difference between the equity crowdfunding and more traditional models like angel investing and venture capital is that, rather than establishing a one-to-one relationship, it's offered to a group of potential investors. Investors' rights can vary. Typically your new shareholders are going to have voting rights on key matters when it comes to running the business or issuing new shares, et cetera. So you should consider how much of the control over your business you're ready to give to external shareholders. And with respect to compensation, be aware that investors may claim damages to compensate money losses incurred. For instance, if there is a breach of contract. You're also going to have to set the terms and choose how much you want to sell, the price, and how investors are going to be rewarded. And honestly, it requires expertise to value any business or venture correctly. Now, the fees payable for raising equity finance on one of these platforms is typically going to be a success fee and a legal or administrative fee. You do need to show that your business is investment ready, so you're going to have a solid business plan and very strong financial forecasts. You should also have a good communication strategy in place with the most important information about your project easily available, easily understandable to those potential investors. Now, there's something called due diligence as well, and that's usually carried out by the platform. And the investor may have the option to ask for more information, and you should be prepared to provide this information, even if it comes at an additional cost to you. And as I said earlier, you should have a business valuation, and there can be other serious legal aspects, the cost of which you shouldn't ignore, such as there could be additional fees for disclosure, other legal documents, annual general meetings with shareholders, processing corporate rights, annual reports, decision procedures, etc. It gets very complicated. Now, one question we've been asked, and I found this with a lot of research, but how much of your business should you be prepared to give up? Well, founders typically give up 20 to 40% of their company's equity. And this is just an equity calculator that I found. So their recommendation is to take the amount of the investment you need and divide that by the value of the business. The total is then the percentage of equity you should be willing to give up. In this example, let's say you need only $200,000. Typically, these are larger projects, but I need simple math. So $200,000. If you're going to divide that by the business's value of 1 million, then you should only be willing to give up 20% of the equity. And think also about what this means. You must have value before you can raise your first dollar. Finally, pros and cons of this. Equity crowdfunding has the promise of lots of cash. It's a way to raise significant funding without without doing an IPO, and it gives you access to more investors. On the downside, it's expensive. Just the administrative costs are significant. And when you add the additional financial, accounting, and reporting that's going to be required, it can be even more significant. Again, you're also giving up control. And you'll need to be aware of the federal regulations and your state regulations and make sure that you're complying with them. Now, whether it's a conventional or a non-conventional loan, whether it's online or not, remember to protect yourself from predatory lenders by looking for some warning signs. Now, some lenders impose unfair and abusive terms on borrowers through deception and coercion. That's just the environment that we're in. What you can watch out for are interest rates that are significantly higher than competitors' rates or fees that are more than 5% of the loan value. Make sure the lender discloses the annual percentage rate and the full payment schedule. And a lender should never ask you to lie on paperwork or ask you to leave signature boxes blank. And never get pressured into taking a single loan. Survey the competing offers, and if you need to, speak with a professional, speak with your accountant before signing for your next loan. And I am finished. I did want to leave you with this information, but if you have any follow-up questions, you can actually email me or my colleague Leo Lopez, and we're at that 304-347-5220 number, and you can contact us at any time. Faith, back to you.
Awesome. Thank you so much, Kim. We just so appreciate, again, such an informative class. For anyone online, if you have any last minute questions, I'll give you just a minute to throw those in the chat box. We'll give you just a few minutes. In the meantime, I'm going to share my screen and pull up the survey for today. All right, So if you can see that on the left, we have today's class survey. Whether you're joining us in real time or if you're watching this after the fact, you are welcome to go ahead and take that survey. It just lets us know how we're doing, what classes could benefit you in the future, that sort of thing. So we really, really appreciate any feedback that you have. And then also the QR code on the right, you can scan and that will take you to our workshops page where you can find additional workshops that we will be hosting in the future. So currently we do not have any questions. So that will conclude our class for today. Thank you again, Kim, for joining us. We so appreciate you and the SBA for providing this information.
Thank you for the invitation.